and gentlemen, analysts and associates, welcome to your Managing Director Secretary's favorite podcast, the Big Swinging Decks Podcast by Litquidity and Mark Moran. This is not financial advice. You'd be a bottom bucket analyst to make investment decisions based on what is discussed on this show.
Welcome back to another edition of Big Swinging Decks. Lit, how we doing this week?
Good, man. You know, we are recording on a Sunday, and it's following permissionless. You know, we were down there for a few days, got a taste of a interesting crypto vibe of a conference. But we'll get into that after.
Interesting time in West Palm Beach, to clarify where we were. But crypto. It's interesting that you bring that up because on today's episode, we're going to be talking about everything that's occurred in the crypto markets and community over the past few weeks with this massive collapse of Terra and everything that has affected. And we're going to be doing it with none other than Mark Lamb, who is the co-founder and CEO of CoinFlex, as well as his wife, Leslie Lamb, who's the chief marketing officer of CoinFlex. So with that lovely setup happening, Lit, anything else you want to tell the shareholders or update them on? What's been going on in your life?
Well, you know, I'm thinking of getting some pizza today. As I said, it's Sunday, May 22nd, the time of recording, and it's Bitcoin Pizza Day. So it's for the people who don't know, this was when some random dude, I can't even pronounce his name, he in 2010 bought 2 pizzas for 10,000 Bitcoin. Which today would be worth around 300 million. So I think he kind of fucked up that one, but I don't know. You've sort of heard that he's doing well, right?
I've heard through the grapevine from someone who is a good friend of his that he's still extremely loaded. But you can kind of imagine that if you had 10,000 Bitcoin at that time, right, that even if you just kept on to a few, you're probably doing very well for yourself, better than the average individual. So who knows? I think the guy also just kind of dropped off the face of the earth is what this person told me. And then they only hear from him, you know, sporadically. But you know, it's a great transition to what we're going to talk about. So let's jump into this and learn a little bit more about what happened in crypto recently and really about stablecoins in general, because I know this is something that for a lot of our shareholders, you know, some people are aware of this, others aren't. So really looking forward to this great and interesting interview. Let's do it.
Let's do it.
Starting off our interview with Mark and Leslie Lamb from CoinFlex. Guys, how are you doing?
Doing great.
Doing well. Thanks so much.
Amazing. Leslie, it's been a few days since we last saw you in lovely Palm Beach. Where are you right now?
I'm in Minneapolis. It feels like the depths of winter again from the 90 degrees that we were experiencing back in West Palm Beach. But I'm here at VCon, which is Gary V's Web3 event. It's the first one that's being put on, and it feels fairly mainstream. You know, there's folks within the NFT space here, of course, and those who are V-Friends, so holders of the V-Friends NFTs. But there's just lots of people, local and also coming from outside of Minneapolis, just super interested to learn more about what crypto has to offer. So it's been a pretty exciting past week at these two events.
Amazing. So for our shareholders who aren't familiar with these crypto conferences, what is the vibe like at this one versus in Palm Beach, where we were all together earlier in the week, with the exception of Mark Lamb? But, you know, that vibe in Palm Beach, it was different than, say, Bitcoin Miami. How would you describe this VCon?
So VCon is specifically focused on the NFT space, as Gary Vee himself has gone deep dived into NFTs, not only through VFriends, but also in helping through VaynerMedia other brands start to activate NFTs as part of their branding exercise, right? So it's been very, very focused on that part of the ecosystem, whereas permissionless, I think it was fairly heavily focused on DeFi specific topics. There were a few panels here and there about NFTs, but we saw a lot of protocols for the first time in person as a team. And so that was different from Bitcoin Miami, which was a very, very mainstream event. I mean, you're Uber or Lyft driver was talking about crypto and their portfolio. And there are about 30, 40,000 people coming in and out of the convention center in Miami. And I saw, families and little kids also like through that event, which is not something that we saw many, many years ago. So that's kind of the difference from the past 3 events.
My
Awesome.
Uber driver was actually on the way to permissionless was talking to me about crypto. So he was actually telling me what he had in his portfolio and what I should buy. So I thought, wow, that is, the signs of the top, even though in the midst of the sell-off. But and so Mark, where are you, today? And we missed you at the permissionless. Hopefully we can see you in the next one.
Yeah, I'm looking forward to the next one. I think the next event for me will be the Austin consensus event. I'm here in Dubai, so yeah, it's rapidly becoming the kind of, for outside of the US, it's probably the epicenter of crypto, or on its way to becoming the epicenter of crypto. They're kind of very forward thinking with a number of crypto specific policies around regulation and tax and just a whole bunch of different things. And so, it's attracting people from Asia, it's attracting people from Europe, the UK, and they're also very forward thinking in terms of travel. A lot of Asia is still locked down, still has these concerns around COVID, but over here, 99% of people are vaccinated, whether you believe in it or not. 99% of people are vaccinated, and you can go in and out without a quarantine or anything like that. So yeah, here in Dubai, loving it.
Love that.
Nice. And so for our shareholders who don't know, you guys were previously in Hong Kong, then now in Dubai. Leslie, you're obviously in America, but since we last spoke with you, Mark, the rollout of CoinFlex US has started, and so would love to get an update for everyone and hear what's going on.
Yeah, well, the exciting thing I think is we're rolling out. We just launched CoinFlex US, which is going to be focused on flexUSD. So flexUSD, for those who don't know, for those who are hearing about it for the first time, flexUSD is the only interest-bearing stablecoin, and so it pays interest to holders every 8 hours, and that interest comes from our futures market. And the reason, the source and the reason for that interest is basically people are long futures contracts, pay funding, and someone has to take the other side of that trade, and flexUSD is holding crypto and short crypto futures positions. And so flexUSD is really collecting that funding, collecting that financing charge. It's similar to how a bank might lend against a house, and the house is collateral. And so if the person defaults, the bank is okay. flexUSD is lending in the same type of way. It's a secured or collateralized type of lending activity. And flexUSD as a stable coin is one-to-one redeemable for US dollars in the US or USDC in the US and internationally. And really, the interesting thing about the rollout is really the Terra Luna UST collapse. Because at the same time...
Great transition, because we were going to ask you right about that next.
Everyone's been asking, yeah.
Everyone's been asking about it. People have been worried about flexUSD because of it. A lot of people that are more sophisticated and more knowledgeable about both stablecoins have just said, wow, you guys have such a big chance now to come in and replace the trust that usually gets destroyed in the short term. And I've been in crypto a long time, obviously, and a lot of people have asked me, well, do you think no one's going to be trusting kind of innovative stablecoins because USD collapsed? And I said, well, that's kind of reminds me of the question people asked with Mt. Gox when that collapsed, and other exchanges and other forms of businesses when they collapsed. Do we think futures markets are just going to be over because BitMEX went down, or this or that? No, I think the nice thing about this space is because you're exposing the end customers to the inner workings of all these products, they become sophisticated very quickly. So, I mean, you see this even with just retail investors versus institutional investors. People traditionally think that institutional investors are sophisticated and retail investors are, a bunch of idiots or a bunch of gamblers or not in the know or whatever. Well, crypto flips that on its head, because retail investors can spend hours and hours and hours looking at a protocol in their non-working life, or maybe they don't have jobs, they just do crypto full time, and become more of an expert than someone at an institution, someone working at a hedge fund, because that person working at a fund might not be managing their own money, but that retail guy, he's putting in his own time and effort and his own hard-earned cash. Whereas the guy at a fund, he might be managing someone else's money. So I think you saw that with the UST collapse. I suspect, and this is pretty well backed up with on-chain data, I suspect that 80%, maybe 90% of the capital in UST was institutional. Family offices, funds, hedge funds, crypto businesses put dollars into UST. And the reason why it seems like that's the case is about the top 1,000 addresses were all $1 million plus. And so 80% of the supply, I think maybe 8 or 90% of the supply was these top 1,000 addresses that had over $1 million in them. And some of that might be retail millionaires, but right. I think that's mostly businesses of some sort. And so I think this was a really interesting failure, because it actually showed that institutions can do really dumb things as well. And a bunch of institutions put money into something that was structurally unsound, fundamentally had Ponzi-like dynamics to it, and wasn't worth $1, even though it was claiming to be worth $1. It was backed by something that had no business being worth $1. And so we've seen a lot of those. Yeah, go ahead.
Sorry, yeah, no, I was just pulling up some tweets that I saw over the past week, and you mentioned the institutions that lost a lot of money, and like one of them being Binance. I see one from @TheCryptoLark said, "Crazy that Binance lost 1.6 billion on their Luna investment," and then another one from Unusual Whales that said, "A crypto wallet linked to the South Korean venture fund Hashed appears to have lost some 3.5 billion." Yeah, that is. Some, as you were saying, like the institutions got that wrong, and they were the ones that really got wrecked from the collapse.
Yeah, and I think it's a perfect time for flexUSD in many ways, because when we had talked to funds and these types of institutions about flexUSD, the biggest thing that they would say is, well, I can earn 18% on my dollars in UST and in Anchor, which is the Terra product that pays interest or paid interest. And so we were just getting really tired of that response, because it's like, we would sometimes spend a few minutes and try to explain to people why that was a bad idea or why that didn't really make sense. But people don't want to do the due diligence. They don't really want to see that. They just want to earn their 18%. So now kind of the market learning this lesson really creates an opportunity for flexUSD. And we're really excited about that. So, it's the losses are super unfortunate. I think if anything, this also just demonstrates the importance of shorting. Because this system could have gotten, there were people like Galois Capital, it's spelled Galois, but I think it's pronounced Galois Capital, who were short Luna and maybe UST, according to tweets they gave publicly, and I've talked to them about this as well. But there were people who were talking about this stuff, and if there wasn't this profit motive to cause this to end earlier than it ended, or to cause this to end earlier than it could have ended, this scheme could have potentially gotten to be worth 100 billion, 200 billion before eventually collapsing. And I think that would have been a fate that would have impacted more people. If this could have been kind of exposed and educated and brought to the attention of the market and shorted, when it was only 500 million or 5 billion, that would have been a much better outcome than the market losing around $50 billion, which is kind of what happened.
And so for our shareholders, to make it a little bit simpler, could you kind of describe how this essentially culminated and happened for UST, and then kind of transition into then how is flexUSD different, and how can you give the listeners the kind of assurance that this won't happen?
Yeah, absolutely. So UST was a very interestingly designed stablecoin where the way to create units. So a stablecoin is supposed to be worth $1. Crypto token that's supposed to be worth $1. And the way you create units of UST was by buying this newly created token, governance token, called Luna. And so you buy, let's say, $1,000 of Luna, and you have the right to mint based on whatever the price of Luna happens to be on exchanges at that moment in time. You have the right to mint via the protocol, converting your Luna tokens into UST tokens. And so this created a very interesting dynamic where all these people who had US dollars wanted to get into UST. And when they got into UST, what they were actually doing was they were buying Luna tokens, burning them, and in the process, minting UST. And so this actually created a very deflationary supply sink or supply drain or supply burn on the supply of Luna, and it also created lots of buying activity. Because if I want to mint $1 billion of Luna, I have to buy, and I might do this $1,000 at a time, or I might do it more aggressively than that, but I have to buy lots of Luna, and then I mint it into UST. That's how I get $1 billion worth of UST. And so there were a lot of people that wanted this UST stablecoin. Now, why did they want this stablecoin? Well, the stablecoin had another project, which was closely linked or directly tied to the stablecoin, called Anchor. And Anchor was basically intending to be a lending platform, and it basically said, we promise to pay 19%. Now, that's a very interesting claim because that's a very high interest rate. In theory, if that interest rate was coming from people borrowing, that would have been a great system. If I can pay depositors 19% and I've got borrowers paying me 25%, that's a great business for me because I'm making money, my lenders are making money, my borrowers are crazy. And,
it's like a bank.
It's like a bank. But actually, they weren't doing that. They had borrowers borrowing at basically between 1% and 6%. And they didn't have very many of them either. So they had very few borrowers. In fact, out of the 19, only 1% of the payout was coming from what I would call real world activity or real world borrowing. The rest was all subsidized by the protocol. So the platform actually just put in $500 million and hundreds of millions of dollars into this system and said, hey, we're just going to fund the difference between 19% and 1%. So we're going to fund that 18% out of our own pockets. Now,
and so was this something people saw coming then? Because it seems like the way you're describing it. Okay, interesting.
It was so just like Mt. Gox, if you were paying attention, and you had to be paying attention to people that a lot of the community didn't like. Galois Capital had been tweeting about this for at least a month. And I'd viewed UST as a bit of a decentralized Ponzi scheme for many months. So if you'd paid attention, it was very obvious. It was extremely obvious that this was a fundamentally flawed system that was at some point bound to collapse. But the thing that's interesting is it's worth noting. So when the supply of UST is going up, Luna tokenomics are amazing because that price of that thing it went from, sub $1 to over $100 in a very short period of time. It became I think at one point it was in the top 5 of tokens. and huge volumes. Koreans would speculate, Americans would speculate. Galaxy made a third of their balance sheet Luna. So they bought enough Luna that it was a third of their balance sheet.
That's Galaxy Digital, right? The Michael
Digital.
Novogratz. Yeah, he has that tattoo of Luna on his bicep, right?
And I think Galaxy are an amazing business, and I think Novogratz is a very smart guy, very good crypto operator. But they had a lot of legitimacy because on the way up, the reflexivity. There's this concept called reflexivity, which is kind of like when something starts being perceived as good, the fundamentals actually change such that it becomes better. Kind of this relationship between social perception and fundamentals is very strong. And the problem with Luna and UST is that the reflexivity is both on the upside and on the downside. So on the downside, when you start getting redemptions, they'd never had a situation where there were a large amount of redemptions. And let's look at how redemptions work, right? So if I take that $1 billion and I say, actually, I want it back into cash, the way I do that is destructive to the Luna token. Because what I'm doing is I'm saying, I'm going to burn my UST, I'm going to get Luna, $1 billion worth of Luna, which will be new supply, printed out of thin air, and I can sell that on the market. And this is why when UST was 50 cents, there were people that were able to convert one UST into $1.
Right.
Not many people. Only the smartest and savviest with the blockchain institutions were able to do this. But they were able to convert it into $1 because they would burn one UST and they would sell Luna tokens as fast as they could, and they might get close to $1. Even though, and that's why they were buying it at 50 cents. It's not because they thought it was going to go to $1. It's because they thought they could actually extract $1 same day through dumping Luna. But that process meant that Luna, after it had gone, Luna had a period where it went down 99% in a day, and then the next day it went down another 99%. So that was crazy.
Yeah, I saw on this article from CoinDesk that the total supply of Luna went from about 725 million tokens on May 5th to about 7 trillion on May 13th. Which is kind of like, a very exaggerated situation of what's going on with U.S. dollars, but it's that's real hyperinflation right there, and it's like when you just print that out of thin air, that's what is that really worth?
So one interesting thing about that 7 trillion number is the market cap of dollars is 70 trillion. So for Luna, another way to think about it is for Luna to get back to being worth $100, which was close to its peak, it would have to have a market cap, if there wasn't a lot of burning, it would have to have a market cap about 10 times the size of the US dollar. So
which is not going to happen.
It's almost, yeah.
And so kind of what you touched on a minute ago is that this was something that some people in the community saw coming, right? And a question that just pops in my head, though, is for you or Leslie, you as well, for people who are kind of leaders in this community, you see something going on like this. How do you view your personal responsibility to speak about it, to tweet about it, to really kind of warn others versus, just kind of seeing what's going on online? Because I think, in this space where there's a few leaders that people look to and there's a few vocal people that are talking about it, when you have certain groups that are kind of not as popular as you were alluding to with this, talking about it and people kind of being skeptical, how do you view your role? I'm just very curious with this.
So I think having conviction is much easier than being vocal about your conviction. I would imagine if you raise the hood on the crypto community and you brought us all together in a Chatham House type meeting, and you had everyone speak the truth about what did you really think about UST, right? How long had you seen this coming for? And, really give us your analysis on why you had this conviction that UST is a Ponzi scheme, and how the economics just, didn't make sense for something that was positioned, or something that had positioned itself to be a sustainable stablecoin for institutions and retail, right? If you put us all in a room, I think maybe you'll get closer to the truth. But it's very difficult to be vocal on somewhere like crypto Twitter. And this is something that the CEO of Galois Capital that Mark mentioned, Kevin Zhou, he said this in a podcast interview that he did after the collapse. He said, it is very, I took on a lot of heat from the Luna community, right? And that's the thing about crypto. You have tribes, whether it be
you have tribes associated with various coins, which is something fascinating for someone in traditional finance, that it's like you don't have euro enthusiasts who are just on Twitter tweeting about it with certain hashtags.
Euro's amazing,
right? It's crazy. It's such a unique thing about crypto and Twitter, obviously.
Yeah, I mean, but not just coins though, right? Blockchains, right?
Yeah.
I'm a Bitcoin maximalist. I'm an Ethereum maximalist, Solana maximalist. I mean, you have tribes of enthusiasts, and obviously that does well for the community, because the more of these diehards you have, the more builders there are, networks effects get built out, word of mouth goes around, developers then really start to trust, like, this is an ecosystem that's not going to go away, and if I spend my time building a project, the fruits of my labor are going to be sown, because there are going to be end users on the platform, right? So, like, from that perspective, it makes a ton of sense to have these kind of tribal systems. But on the flip side, what ends up happening is you just get a very toxic community when things are spoken negatively about the project.
Oh, yeah, I mean, that's...
right? Because, you just have short sellers who want to manipulate the market and, are just talking false claims or making false claims about a project. For Galois Capital, he was very, very methodical about his comments about the whole Luna and Terra USD relationship, and how he thought, one, it's not decentralized, two, that it was going to turn out to be this way. He just didn't know exactly the time. He would never go out and claim within 1 month, yes, I knew exactly this was what was going to happen. He said, look, like, I couldn't have anticipated how fast this whole thing played out. He wouldn't have been surprised if it took 6 months to play out, right? So the timing wasn't what he was trying to, push and say, right, just know that at this point in time, this is when this short is going to be put on the market, and Luna's going down. If he came out and said that, I mean, it would be ridiculous, right?
Yeah.
But
I would just say, like, calling out things like that. You have, like, the Michael Burrys of the world, right? Like, in the traditional finance markets, when he was made famous for the whole housing collapse and all that good stuff. But then you have the flip side. You have like a Bill Ackman, who now is just getting flack whenever he launches a short position, and he calls something a Ponzi. I think what Herbalife was like the main one that I recall. And so it's you have to have the conviction, but you can also be right or wrong. And I think in this case, there was a sort of, people knew, because it was an algorithm, that there was a way that this could theoretically unfold in the way that it did. And so, to your point, it's like this was more of a clear-cut thing than, say, like a company engaged in like a, buying, selling of goods, that were just different. But I think where I'm going with this is that, like, there's so much toxicity there. Like, Bill Ackman gets a lot of flack nowadays, and you have to live with that. And I think that's part of what Mark and I see whenever we start to troll some people just for good fun. People are impassioned, and they'll go after you. So I think, at least for me, the benefit of just having a little anonymity helps me to avoid some of the full toxicity. But yeah, it's social media is a very toxic space indeed.
Being an exchange platform, I think, makes it more challenging because our role in the space is to be a marketplace, right?
Mm-hmm.
We're not partial to one particular blockchain to say we only want to support the coins that are launched on this one blockchain. Can you imagine if that were the case, right? What kind of marketplace would this be for people? Not a very big one, nor a very liquid one. And so the biggest exchanges out there are ones who support the entire ecosystem. And from a founder's point of view, right, from management point of view, it's our job to filter through, right, just as an exchange like Coinbase would in the very, very early days. This was, 2014 or something, where, you knew that if you wanted to get listed on that exchange, this spot exchange, you had to go through rounds and rounds and rounds of due diligence because there was only a few coins that people could trade. And, as an exchange now where there are so many coins out there, right, so many blockchains, then the question is, what do we list? At what point in time, right? What do we allow for our traders to trade, buy and sell? So Mark, maybe you can talk to us a bit about how you've seen your role as an exchange operator kind of evolve as the token, as the space has just become so much more noisy over the years.
Yeah, I think it's tricky because we have these conflicting roles, and on one hand, everything Leslie just said about wanting to be a neutral marketplace is completely spot on. And on the other hand, I do feel like there's a bit of a duty as a business in crypto, to communicate to the public when something has become an enormous risk, a high probability risk, a systemic risk, and something that, they should be careful about. It's a objective fact that everyone I privately warned and anyone who read our Medium post describing the differences between UST and flexUSD, who had read these things and gotten out of UST has not lost money because of it and has made money. It's also a fact that if you warn someone about an experimental system and that experiment turns out to be brilliant and works really well, then you've actually prevented them from making money. So it's difficult in crypto because as much as you might look at something and say, this looks like a Ponzi, I feel like I have a high conviction that this is, not going to work. Some things surprise you. And some things, I didn't have I had a lot of conviction on Bitcoin very, very early on. I didn't have the same level of conviction I did about Ethereum. And obviously I was wrong about that, but I might even have more conviction about Ethereum than Bitcoin at this point. So, in fact, I don't even think that's a very controversial thing to say. And so
don't ask Jack Dorsey on that one.
Yeah. I mean, it's just it's a tricky one, genuinely tricky one, because there's a lot of competing dynamics, and I do think there's a lot of value in. I think this is actually where the value of short sellers are, because as an exchange, you can't necessarily do this role, but Algode and the other high-profile people that made short bets against Do Kwon. Those were very high publicized for people, for your listeners that don't know. There were two traders who basically tweeted at Do Kwon saying, hey, I'll bet you $1 million that Luna will be lower. And then another guy stepped it up, said, hey, I'll bet you $10 million that Luna will be lower in a year. And within a few minutes, they'd put USDC into escrow with someone named Kobe. They just sent him USDC and did the bet with Do Kwon, and Do Kwon funded it as well. And most likely in about 11 months or something, they're going to make $11 million, 10 and 1. And so if, those bets played an important role, in drawing attention to the structural problems of UST, and people often kind of make fun of short sellers because they should be made fun of. Most likely, or most of the time, they're wrong. Stocks go up over time. Crypto, especially the bigger cryptos and more tried and true tested cryptos, generally speaking, goes up over time. So you should make fun of short sellers, but at the same time, when they are right and when they do draw attention to things that are scams, they're creating a huge amount of value for society.
Mm-hmm. One thing that I've noticed going back into all of Do Kwon's tweets was that he was also very arrogant in the way that he was, like talking down to the shorts and the people who said, Luna and Terra could unwind, and he would just say, you're all going to be poor. I don't talk to poor people, and all these have now resurfaced. I'm like, hey, you kind of brought all this shit talking back to you for having all that. So I think that's also, like now the chance for the short sellers to gloat, which, I love a little bit of the Schadenfreude, seeing like when people are, they have shit coming to them. So, but yeah, I mean, I do think like it does set back crypto in the sense of public perception at large for like the mainstream who barely understand what crypto is. Mm-hmm. When they now just hear, hey, like stable coins, now they associate that with the one that collapsed, not all the other ones that are good and are much more stable in the actual sense than something that's computer programmed. So I kind of want to turn the question a little bit to the difference then on, say, like, Tether and USDC, right? Like they are some of the largest stable coins out there. And they're not algorithmic, right? Like they have reserves and collateral that are, I guess, they're not 100%, like backed by dollars, correct? Like there's a majority of that is, and then there's a basket of other low volatility assets. Like, could you explain kind of how those work, and then how flexUSD is more similar to Tether and USDC than a algorithmic type of stable coin like Terra?
Yeah, sure. So one way to think about it is that Tether and USDC give the majority of their money to the U.S. government in exchange for treasuries, or they buy treasuries on the open market and they hold them to maturity or to later in the lifespan of the treasury note. Basically, Tether are lending via Tether and USDC are lending via very, very safe mechanisms, primarily to the government and other corporates in the form of traditional fixed income instruments, treasuries and otherwise. They're also holding cash. And in the case of Tether, they also have commercial paper. Commercial paper is maybe riskier because it is an unsecured debt, albeit to maybe a large company, but it is an unsecured debt that might not be repaid. Mm-hmm. But they're fully backed by this basket of fixed income instruments, loans, but fixed income instruments. And the biggest of them being loans to the U.S. government, which, as Alan Greenspan once said, there is a 0 chance of default because we can always print more money to do so. So those loans specifically, those treasuries, are extremely safe instruments, the safest in finance. Now,
it's basically the risk-free rate that they use to calculate DCF. So yeah.
Exactly. And so the
nice TradFi reference in there. I like that.
The shareholders will love that
calculation.
Yeah,
they're gonna go crazy for that little detail. Sorry, Mark. Go on.
No, I love it. So the basically Tether and USDC are doing that, and the difference that flexUSD has is, if you think about lending as unsecured lending, which is like, I'm going to give you money and hope that you repay me back. Please do so. So unsecured lending includes like credit cards, student loans, stuff like that. It includes commercial paper. So Tether do a bit of that. But the majority of these two stablecoins are backed by legally very secured lending instruments. Now, what CoinFlex is doing is a form of secured lending as well. It's secured lending in CoinFlex's repo market, which is a fancy term to describe owning crypto and being short the same amount of crypto in futures. So if I own 10 Bitcoin, I'm also short 10 Bitcoin futures. Now, this is a inherently safe position because I'm not giving my dollars to someone else. I'm not going off and saying, oh yeah, please pay me back. It's secured. It's secured by the 10 Bitcoin. And you have the futures position. And so because you have the futures position, you're not exposed to the Bitcoin price. Bitcoin goes up 1,000%, Bitcoin goes down 90%. Either way, you're still actually worth the same amount of dollars. You put $1 million into this equation.
It's because your shorts basically like offset the price
any
movement.
P&L from the Bitcoin going up or down.
Right.
So
okay.
Bitcoin goes up, you lose money on the shorts, and the difference between the two equals the same amount of dollars. Bitcoin goes down, you make money on the shorts, and that offsets the fact that Bitcoin went down. And so it's a very, very simple trade. Not complex. You can explain this trade, owning spot, buying spot, and selling futures, to just about anyone. Definitely anyone that understands what a futures contract is. But once Google futures on Investopedia, and read up on what a futures contract is, and once you combine that with what I just said, you'll understand this trade. I guarantee you. The flexUSD is putting its money into this trade, and it's specifically putting its money onto this trade on CoinFlex, and because it's secured with collateral, it's 100% backed. So during the crash of UST, we had people, funds, hedge funds, high net worth individuals, billionaires, we had people that were redeeming flexUSD. And they actually redeemed 1/3 of the supply of flexUSD in 24 hours, which, wow. Yeah, that's a lot for any stablecoin. But the great thing about being a fully collateralized stablecoin is we processed every redemption. We could redeem 100% of the supply in a day if we wanted to. Not a problem, And so those went through, and in the 24 hours after that chaos, that massive maelstrom of events, we had the exact amount that got redeemed or minted by some of the same people and some other people as well. And then we had positive growth. We had more flexUSD than before. So it was this scenario that proved out the fact that it's collateralized, really, because we can redeem 30%, a third of the supply without issue in 24 hours, and it's fine.
Got it. Yeah, and so like what I would say that there's less risk than in a Luna Terra type situation, but how would flexUSD be prone to certain volatility in, say, like Bitcoin or other types of crypto? Like in an apocalyptic scenario, how could flexUSD lose its peg, and how do you protect against it?
Yeah, so really the question is, again, I talked about how you have this corresponding futures position. Well, if that really works, as long as CoinFlex is saying that for every $1 that Bitcoin goes down, you're going to get paid $1 on your futures position, or if you're short 10 futures or 100 futures, $10 or $100. But if for some reason CoinFlex can't honor that promise because of a margining failure, that's where flexUSD can have issues. And so this really gets into the differences in margining between crypto and the traditional finance world. And so in traditional finance on futures exchanges like CME and ICE, basically the way it works is you get a margin call. And that's often a physical call from the brokerage firm to the end client saying, hey, please post more margin. Please send us $10 million by start of business tomorrow. And you might have 12 hours to do that, or whatever, 24 hours even. Well, in 24 hours, a lot can happen. We don't assume our clients are good for 24 seconds. So
right. Well, if you look at memes, like on Twitter around that, if you get margin called, they recommend you just don't pick up the phone. So
yeah.
You delete the app and just move on.
Yeah.
I mean, because maybe the market goes up and then you're fine again, or if it goes down, they're going to try to sue you. But no, totally, because it's a flawed system. It's a system that's hoping that the clients can pay. And on big futures exchanges, they're only dealing with big institutions, and so they have this kind of, they probably can. But you have these problems, like there was a blow up in the Norwegian or the Nordic NASDAQ OMX, where they had an energy trader that was actually a clearing member of the exchange, and he lost his entire net worth and went bankrupt in like 2 days or something. Jesus. Because of he was long like a couple hundred. He was worth about $500 million. He amassed that net worth from trading. Literally day trading. He was doing this smart trade that was, when energy prices get disconnected between one energy market and another, you buy the cheap one and sell the expensive one. And for a while that works really well. And then if there's too big of a storm, well, you lose your entire net worth. So that's what happened. And the clearing fund at NASDAQ OMX actually lost $100 million. Which out of $150 million clearing fund. So that was a big hit. And so the thing about crypto futures, we liquidate in real time, partial liquidations in real time when the client is running low on margin, well in advance of them getting to a zero equity situation where they might get to a negative equity situation if the price keeps going down. We do partial liquidations that are designed to have low market impact because they're a very small fraction of your position at a time. And then in that way, we can trim down your risk before you get into a situation where your account is completely bankrupt. And we might even trim down your risk such that we don't need to zero out the account. We don't need to liquidate you. We just trim it down a bit, and then the market goes into the right direction, and then you're fine. But either way, the result is that the market impact is very low. We're able to clear off risk, and we're able to ensure that in real time we can have no risk to the insurance fund on CoinFlex. And that's why our insurance fund has about $50 million worth of assets in it. And we've used almost none of that. I mean, in fact, the insurance fund has made money because when there's excess margin, that all gets swept, from a liquidated account, that all just gets swept into the insurance fund. And so that excess margin has actually built up, and the insurance fund has actually grown as a result of the way we liquidate people. So it's a very conservative approach. It's not one we invented at all. In fact, most of the top crypto derivatives exchanges are functioning very similarly to CoinFlex. And because of this approach, you just don't have this stuff happen anymore in crypto. Sometimes an insurance fund takes a hit here or there at this exchange or that exchange, but you don't have these huge blowups where there are these losses. So that's the reason why flexUSD is safe. It's from real-time margining and a huge insurance fund backing it up, and ultimately the fact that it's real-time means we don't have a lot of risk on the books.
It makes a lot of sense. Yeah, that's the real-time thing is very fascinating. It's just like unique to crypto compared to the traditional markets, in the stock market and also the futures market, where you look at the CFTC or anything like that, and they don't mark to market 24 hours, right? So so then one question then that comes out of all this is the calls to regulation that are now, coming up in Congress, and like, what do you think will come out of this with regulation, and where do do you think there should be guardrails in place for preventing other types of stablecoin collapses? Say like as you mentioned, like much earlier in the episode, that it wasn't. I mean, it was big, right? Like, I think there was about 40 billion that was lost, but like, had that been later down the road, that could have been even more catastrophic. So, like, where do you think regulation goes from here?
I think there's a few components to that, and I think there will be. We are extremely bullish on the U.S. as a regulatory landscape for stablecoins. That's why we launched CoinFlexUS, but we're bullish on America figuring it out faster and better than anyone else from the perspective of regulation of stablecoins, because I think they have a very sophisticated understanding, and the understanding is really coming out of the Fed, the Federal Reserve, and the Treasury the language Janet Yellen gave in her speech following the UST collapse was not that of someone who has a cursory knowledge and a simplistic view of the stablecoin space. That it was the language of someone who knows exactly what's going on and knows that there are good stablecoins like USDC, Tether, lots of different well-collateralized stablecoins, and that there are completely reckless and dangerous stablecoin projects. And that's exciting. The fact that they're taking this nuanced view means they're probably going to come up with regulations that enable people to create stablecoins that are really useful for the world, while also, making it harder for stablecoins that might have bad effects on the world to gain acceptance and adoption in the U.S. And that's probably a good thing. So I was bullish on the U.S. before all this happened. I listened to the reactions very closely with a keen eye to see if any of them would change my viewpoint and change whether we should be as bullish as we are on the U.S. Regulatory landscape. I am even more bullish after this on the U.S., and I think they're going to get it right, and they're probably going to get it right quickly as well. I mean, legislation takes time. The good thing is they're not trying to pigeonhole this into existing laws, like, for example, securities laws or something like that. So I think that's a positive. Stablecoins are a new product. Don't put them into existing frameworks. But I think they will come up with a new framework for stablecoins at Congress, and it's going to be amazing.
Fantastic.
Perfect.
And so one of the questions that I have is that, with this going on, like, I think about how my parents view this, right? And so for them, they're just hearing, stablecoin, and they're going to associate that with all of the stablecoins, right? And it's almost kind of like a marketing issue that potentially you guys have moving forward for a little bit, right? Yeah. And because there's no kind of centralized source of information in crypto, like even in traditional finance, CNBC, Fox Business, Bloomberg, yada, yada, right? Most of the information is coming out of there. In crypto, it's much more decentralized. And so how do you guys think about it, kind of the next few weeks, the next few months of telling the story and really being able to kind of speak to people to not only reassure them, but to really kind of put out what is actually going on?
Yeah, and that's the main challenge, but it's an opportunity, I think, for us right now, where you have a lot of the noise cleared out, right? When it comes to stablecoins, let's remember, it's really about the utility. It's gotten to $162, $billion, not because of the yield aspect of stablecoins. USDT didn't come out and say, hey, if you stake USDT in some protocol, you're going to earn some sort of yield. USDT got to be the number one stablecoin for pragmatic reasons, because corporates were using it for payment settlement purposes. Individuals in countries that had capital controls, such as China, were using USDT because they didn't have a means to get money's fiat out the country. And so they converted that into USDT to invest and buy property and take their funds out of the country, right? So it's because of the pragmatic reasons that USDT got to be so quote unquote trusted as the de facto stablecoin of the crypto space. And then USDC came along and pretty much put forward a more professional face to rebrand stablecoins in some way that was, more legitimate, right? And this gets to a point that I've been making ever since this whole conversation around Terra Luna and its collapse got started, which is when you assess the attributes and risks of stablecoins, just see whether it fits this trifecta. The trifecta of stability, what is its depegging risk? And in order to make that assessment, you have to understand how it's collateralized. And we already talked about that a whole lot during this conversation. So that's number one, stability. Number two is transparency. What is your insight into the collateral reserves, right? For flexUSD, I don't know if Mark's mentioned this already, but Armanino, which is a leading US auditing firm, will be attesting to the reserves of flexUSD 3 times a day, intraday attestations, for you to be able to see for yourself that the reserves and the number of flexUSD outstanding are always on a 1-to-1 ratio, right? So there's that transparency.
So when I go to sleep, and then I wake up 8 hours later, I can check to make sure that all that's there.
It's
Amazing.
Some guy, they're going to be like, it's
24
still
hours a
good.
day.
Yeah.
Yeah, exactly.
Yeah.
Yeah.
So that's the second point, transparency. And the third aspect is redeemability. It's under market stress. What is the liquidity risk? When everyone is trying to redeem that stablecoin at the same time, what is your ability as the issuer to process those redemptions? And as Mark already mentioned, we were able to do that very successfully for everyone who wanted to redeem. So if you can assess based on stability, transparency, and redeemability, you're going to be able to filter through all of these other stablecoins out there and begin to categorize for yourself. Is this something that I want to be using? Is this something I can trust? Whether it be a longer term play or a shorter term play, going back to that point of utility, right? Making payments. So point being that, right, when USDC came along, put a more professional face to stablecoins and, became the number 2 stablecoin. Now, that really allowed for legitimacy to be baked into the stablecoin narrative, right? And we talked about regulation. Jeremy Allaire, founder of Circle, has been doing the bidding of the ecosystem, working and speaking to Congress. We need a leader like him to continue the education around stablecoins, such that it doesn't just get, what's the term that's used, like throwing the baby out with the bathwater? Just because, the whole crypto market's going down, we should just dismiss stablecoins to be some sort of volatile asset and then just regulate them away very willy-nilly, because of the market volatility. No, actually, it has a use case. That's why CBDCs are top of mind for nation states, right? They realize this digital dollar is really the way forward for, kind of payments between countries, obviously, but even for individuals. We're seeing tech push forward, the way we interact with each other on a payment space is, very, very quickly, right? Right now before it was credit cards, and now it's Apple Pay, paying with your face, paying with your watch. What is that going to look like down the line? What role does stablecoins play in the advancement of payments that we're able to do in the future? And so for all the parents who are tuning in maybe, who are fairly skeptical still on stablecoins, this is what I would suggest. Take $100, some small amount that you would consider, to test out of your bank savings account or checking account. Turn that into USDC and send your USDC from the wallet that you create to an exchange. And just see the speed of that transaction, right? And you'll be surprised why your bank doesn't allow you to do this on, that sort of basis so quickly. Now, this is maybe more of a thing for people who are making cross-border payments across countries. Domestically, yes, you can use Zelle. You can make those wire ACH payments, and yeah, it's not difficult, right? Because we're used to it. So maybe.
But that's what I've heard from boomers.
Right.
Yeah, they're like, oh, Zelle is like the pinnacle of fintech. Why do I need
Right.
crypto or even just regular fintech apps?
But Zelle, right? There's a $2,000
Yeah.
limit. At least for Chase. That's
Yeah,
what I know.
right.
Okay, so there's a $2,000 limit. So you want to go past that, schedule it for the next day, right? So there is that limit that doesn't allow you to do as much as you want. Okay, so that's one. Number two, with wire transfers, you're paying $20, right? $15, something like that, per transaction on your own money that you want to transfer from one bank account to another bank account. So that's money that's going.
And it
where?
takes days.
And it takes days.
Yeah.
And if you want to make international payments, and this is something that Mark and I have actually experienced, monies that's coming out of our own account that we own, that we want to send to make payments in another country that we're living in, we're getting calls from Chase, Bank of America, these types of banks, saying, why? Why are you making this payment? And that's getting a courtesy call, by the way, is something that we would love to have. We didn't even get courtesy calls some of the times. We didn't even get email notifications. It was just payment failed. And we're like, what do you mean payment failed? This is our money that's coming from our bank account. We own these funds, right? But with USDC, you don't have anyone in the middle telling you, hey, you can't make this payment at this time. Or, hey, you have a limit of how much you can be transferring, right? On top of that, you have the efficiency of this being on the blockchain, the payment being made on the blockchain, that relative to fiat transactions take almost little to no time to get from one wallet to another wallet. And I think once you experience this, and this is something that my mother's experienced, and now she's, big fan of stablecoins. She's like, wow, like I really should be telling other people that stablecoins is like a great way to just onboard yourself into the space, right? Because again, what we're talking about here, for a functioning stablecoin that's pegged 1-to-1 with a reserve asset like the US dollar, right? You're not exposed to that market volatility that you are when you're holding a Bitcoin or an Ethereum. And so if you're more of a passive capital investor, you're skeptical about the space, you're not really sure you want to be dipping your toes into these, volatile assets, but you still want to, earn interest in the form of, flexUSD, for example. And you want to just try it out, see for yourself. Start small, get in the space, and then figure it out from there, whether this is something that, you can benefit from, right? Think of it as an alternative savings account, if you will. So that's just a long-winded way of answering your question, Mark, which is like, that's really the narrative. At the end of the day, that's really the narrative to the average investor out there right now. I don't know, maybe you want to add something else about that.
Yeah, I would say flexUSD is the best form of dollar that exists today. Zelle, any type of payment system, Venmo, wire transfers, credit cards, they all have a flaw. Regardless of the speed or the convenience, none of them pay you interest while you're using them. And even banks, which do pay you a tiny sliver of interest, it's not coming from the market, and it's certainly not coming from the best, most transparent, most 24/7, most globally accessible market in the world, which is crypto markets, crypto futures markets especially. So they're either not paying you any interest in case of all the payment platforms we talked about, or they're paying you negligible interest, which is the case of banks. And with flexUSD, you get the speed of a stablecoin, the convenience, the speed, the instant settlementness of a USDC with the interest component of a flexUSD. And so that's what we're trying to build here at CoinFlex, is the best form of dollar available. It's going to take a lot of work to really get it to be there, because obviously you have to convince a lot of people to accept flexUSD as payment, as treasury function, as a part of their daily lives. But the good thing is we're building off of an ecosystem, which is stablecoins, which is already accepted. And so, yeah, we're basically just trying to build the best form of dollar that exists. And with respect to all the collapse causing people to not trust stablecoins, people shouldn't blindly trust stablecoins. If I give you a token and I say, oh, this is worth $1, and you don't understand why it's worth $1, you shouldn't just assume it's worth $1. And that's what happened. A lot of
lesson
people,
learned.
Yeah, lesson learned. Good riddance, and good riddance to the notion that a stable coin should be stable just because it's called USD something or US something. There's a lot of tokens now that people are starting to question, and you see other algorithmic stable coins are now collapsing because people are starting to say, wait a minute, hold on. This thing was labeled as USN, US blah, 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 US whatever, but is it really pegged? Is it really backed? Can I get my money out? And so I think that's a great thing. Stablecoins probably were growing too quickly, and a reversion to slower growth with a more educated audience. We're Leslie and I have been in crypto a long, long time, and Sudu, my co-founder as well, have been in crypto a long, long time. Way longer than a lot of these people that have started some of these stablecoin projects. We're going to be in crypto for longer than anyone who's trying to run some short-sighted, scammy type of game. So we don't mind slower growth. If eventually, if you have a compounding growth, you're going to get to everyone in the world. So we're
tortoise versus the hare.
Absolutely.
Yeah. And one thing I'll add just to close this out, I've sort of seen a couple tweets out there. Stable coins should be pegged to certain items that have held in value, like Costco hot dog or the Arizona iced tea. And my favorite, the one that I tweeted, was a New York dollar slice. So I think, with that, like that's, hey, yeah, it gets to the point of, it becomes a joke, but at the same time, it's funny. And I think people now, the silver lining is everyone's kind of talking about stable coins these days, for better or worse, but it's now our role to educate people and tell them, what the differences are from algos to fiat-backed stable coins.
Absolutely.
And with that, Mark and Leslie Lamb, thank you guys so much. I think this is going to go a very long way in convincing my mother what a stable coin is.
Hey, that is
Awesome.
that would be a goal for us if we can get your mom and her friends to just understand one part of crypto through this narrative. I mean, that'd be golden.
Oh, I've got the whole liquidity, mom, dad, grandma, little cousins, all ready to get on flexUSD. So, we'll start to spread organically that way too.
This has been Big Swinging Decks by Litquidity with your hosts, Lit and Mark Moran. This is a Red Rock Music podcast. Our executive producer is Red Yoakum. Our associate producer is Emma Martins. For more, follow us on Instagram at Litquidity and at It's Mark Moran, or visit the official website liquidity.co. So tune in weekly to your Managing Director Secretary's favorite podcast, available wherever you listen to podcasts.